My goodness, this is an absolutely shocking report. I am blown away by this because, folks, this chart that I'm going to show you in the next 30 seconds here is mind-blowing. First of all, I just want to empathize. Most business owners are like, man, this is no 2021 anymore. I empathize with that. Sales and revenues are not what they were in 2021, by no means. Now, did get a surge yesterday because we announced this new AI feature for our Elite Hustlers course, which we're rebranding as a Make Money and Get SH9T Done Faster course. And we had a surge in sales, so numbers are great. Check out that link down below. We've got the price going up on Friday. But what's important is that most businesses right now are seeing declines in numbers. You know, I took a pause from doing affiliates or sponsorships for a while because it really was the right thing to do at the time. And I tried a few affiliates and sponsors again, just in probably for about a month, ending about a week ago. And I'll tell you, they're still not worth it. You know, it used to be back in 2021 as a business owner, you could say, hey, go to metkevin.com/StreamYard, and you get an explosive return for doing that. Even though the product is still phenomenal, paid sponsors like this or affiliates like this, they're not worth it anymore. Now, you can still do that, but they're not worth it anymore. And so by many regards, the economy is softening, right? If you're super, super poor, you're stuck paying high electricity bills and food bills, grocery bills, everything is off the charts, right? Restaurants have gotten obscenely expensive. If you're middle to upper class, you're feeling the recession because valuations are down for your assets. Homes, autos, boats, stocks, everything's hurt, right? If you held bond beforehand, it hurts. Yeah, now we can get higher yields on our cash, which is great, but wait a minute. Is the economy actually in a recession or not? What's going on? Well, if you look at this ADP report that just came out, the economy's doing just fine. In fact, look at the trend. First, the ADP report expectation was 150,000 jobs would be added. But I want you to see the trend of the last 6 months for ADP reports. You ready for this? It is right here. What the heck? That is a trend up. Now, we know that jobs data is lagging, right? Everybody keeps talking about how jobs data is lagging. This should be going negative soon. Well, if it was going negative soon, it should be trending down, not trending up. I mean, that either looks like a RuneScape party hat or an uptrend. And for the sake of this video, it is an uptrend. Look at this report that we got. The April report was 296,000 jobs. The expectation was 150. This Friday at 5:30 a.m., I will be live streaming it. We are expecting 186,000 jobs from the BS report, or the BLS report. Bureau of Labor Statistics will be releasing their jobs report. We're expecting 186,000 jobs. I will be live streaming that live at 5:30 a.m. Pacific time. Mark your calendar for that. But we didn't expect this ADP report to come out with a double. It doubled the expectation from 150 to 296. It's basically a double, which is really remarkable. And it's also the strongest ADP report that we have gotten in the last 6 months, which is also remarkable because, wait a minute, I thought companies are laying off and things should be slowing down. But wait a minute, if you actually think about this, think about how many excess job openings we have. Even though you hear Morgan Stanley is laying off, all the tech companies are laying off, Dropbox laid off 500 people because they think artificial intelligence can do their job for them. IBM says 30% of their back office staff in the next 5 years is basically going to get fired because artificial intelligence will just do their job, like human resources, employment verification, stuff like that. Parts of HR, obviously, not all of it. But that's shocking. AI is revolutionary. If you're not studying artificial intelligence, you are going to get left behind. That's why I'm including it in my Making Money and Get More Stuff Done Faster course. Check out that link down below because the price will go up now that we're adding this. That is on pre-sale. All that AI content is coming out. The actual productive AI content is coming out on June 1st. Mark your calendar for that. But what's remarkable is the JOLTS report suggests we have about an excess of 3 million jobs. Yesterday, I referred to this as the insulated blanket, right? It's the blanket that lets our economy stay strong while we go through job losses. But if you think about it, you could literally get 1,000 Morgan Stanley 3,000 job layoff reports. You could get 1,000 of those headlines, and you would just be at par. Think about that for a moment. Here, let me show you that visually because it's a big deal. It shows you how strong the economy still is, despite the fact that a lot of us as business owners or even employees, we see the softening. Like the softening is here. The softening is happening. We are feeling the pinch. It's starting. I walked into a Hugo Boss in New York and they're like, we're finally starting to see the signs. That's a red flag. So I'm not trying to make like a, super uber bullish thing here. Just saying this jobs report is mind-blowing this morning. And I understand things get noisy. But again, if you look at that 6-month trend right here, the 6-month trend is up. And it's remarkable that the 6-month trend is up like this. But understand this about the JOLTS report because it will help you understand how much of an insulated blanket we have and why the Fed can play this higher for longer game. If we have 3 million excess job openings, right? 3 million excess openings. And we have, let's say roughly for simple math, 6 million unemployed. This means we have 9 million openings, right? We could literally lose all 3 million of those excess openings. So 3 million people could get laid off and take those 3 million jobs. And then you would still be matched with 6 million openings for 6 million unemployed people. How crazy is that? That's what the Federal Reserve is trying to mine down, right? They're trying to get that ratio to a 1-to-1 balance. Right now, you're like a 1 to 1.5, 1.6 if you do the numbers exactly balance. So there's plenty of this insulated blanket. Until we get to 1-to-1, I don't know if we could price in cuts. And this ADP report, at least it's not an wage price spiral style report. The ADP report was actually good in terms of wages. Look at wages. You're still seeing wage gains of 6.7% for people who stay in their jobs year over year, 13.2% for job stayers. But what I'd like to do is rather than just show you this report, I'd like to show you the comparison of this report to last report. And so I manually wrote this out in the Course Member Live this morning. You remember in the Course Member Lives daily, when we do them, when the market is open, we talk about things like the forward earnings call, AMD evaluations, and fundamental analysis. So if you want to passively listen to this really high value content, you want to be part of those Course Member live streams. We might be moving sort of and integrating parts of the Meet Kevin report I had been doing live pretty regularly on the channel into the Course Member lives now and starting those earlier. Because a lot of people are asking for those in the Course Member. So we'll probably start the Course Member live a little earlier. But anyway, look at these changes. So I just wrote them in blue on the right, the April numbers compared to the March numbers. Holy smokes, job stayers. You're seeing a decline in every category of wage gains. Now, I'm not cheering people making less money. People are actually making more money here, right? But none of this is showing you a wage price spiral because none of it is showing you that wages are actually going up at a higher rate than they were last month. And these are all year-over-year comparisons as well. I'd love to see the month-over-month data on this. We'll get that in the jobs report this weekend, this Friday. But look at these changes in establishment hiring. Small businesses went from 101,000 to 121,000 job hires. Medium went from 33K to 122, and large went from 10K to 47,000. All walks of businesses are growing. Look at the different types of businesses here. You still have a slowdown in manufacturing, which, just to explain that really quick, that's because wholesale inventory is still so high. If the orange is inventory, then you have to manufacture less and you could still sell products to consumers, right? So it makes sense that you're seeing some manufacturing slowdown because we just built up so much excess inventory because of COVID days. And we're not growing like we were in 2021, obviously. So even though we planned for that kind of growth, we don't have that kind of growth. But look at leisure and hospitality. I mean, here, massive increase, 98,000 jobs to 154,000 jobs. You're seeing less job declines in the declining segments with the exception of manufacturing. But otherwise, everybody's back to hiring. So it makes me wonder, were these layoffs just a Q1 adjustment and the economy is back to crazy growth? But again, go to this April report, and the fact that this April report is showing us we added twice as many jobs as expected, 296,000. That's setting up for we're not in a recession yet. Maybe the recession was last year and that's it. And inflation goes away and things are good and we just Nike swoosh recovery. I still believe the Nike swoosh recovery. It's every single day that people are like, oh, Kevin, you flip-flop every day. No, I don't. Literally, I told you, and I've been saying it, Nike swoosh volatile recovery. The stuff you buy today, I think we're going to look back 10 years from now, and we're going to look back and go, damn, I wish I bought more. It's going to be volatile. Yeah, there's going to be an SH9T storm every day with this volatile data, but that's because we're in such uncertain times. But I try my best to parse through all of the data. And the data just isn't that scary. The banking crisis is nonsense. Yeah, we're going to have fringe banks fail, but I really don't see something massively systemic. And I'm not just trying to reiterate talking points. The First Republic balance sheets weren't actually that horrible. Yeah, they had way more loans than cash. We know that, but every bank does. So does SoFi, okay? Way more loans than cash. They've got about 25% of their loans in cash. It's not me saying, oh, pull your money out of SoFi. No, it's just, I'm not saying there aren't going to be more banks that fail. But do we think we're going to have a 2008 style banking crisis? No. Do I really worry about dollar de-dollarization? Losing the reserve status of the world? No. Do I really worry about the debt ceiling? No. But I've also made that clear in all of my videos over the past months. Am I really worried about, this was a great stat, by the way. We did this in the course member live stream. Our good buddy Steve, he's like, hey man, but what if international imports slow down? And we did the math and we're like, okay, if Chinese imports of United States products fell 10%, it affects our GDP by like 6 basis points. So in other words, if our GDP is 1% minus 10% Chinese imports, we'd be at like 0.94% GDP. Kind of interesting. Europe had about twice the impact. But anyway, that kind of analysis I think is very interesting because it really lets us cut through the emotion of the headlines and see, wow, there's still some really strong shoots in this economy. That's not saying we're not going to go into a recession, but the idea is what we're doing. I really like the insulated fire example, okay? Because I think it's the best example. Is what you're doing is you're saying, here's us, and we're uncertain, and we're in a box, okay? We're in a box that has insulation that looks like this, and the insulation is jolts. It's excess personal savings, still in excess of $1 trillion. It's personal, a percentage. It's the percentage that people are spending on their debts for their household expenditures is actually at a lower percentage than it used to be, even though, yes, debts are rising. People are spending less on a percentage of their income on their debts, which is good. Then it's jolts, it's job openings, your ability to get another job. And really what's happening is you have this fire, right? And the fire is trying to burn through this insulation, and the fire is the Fed raising rates. It's kind of like a cavity, it's trying to drill in to get to the nerve. And this is creating a lot of fear and uncertainty. And that fire goes away, and that cavity, so to speak, stops growing as soon as inflation is gone. So the hope is that we can kill inflation before it penetrates the box that we're in. And as long as we could do that, we could go back to being happy. But there's still a little bit of an uncertain face right there. But the point is, obviously, get into that course that's going to have an amazing AI segment June 1st before this Friday, so you can get the best pricing on it because we'll be raising the pricing since we're adding all this extra content. But everybody inside is getting it for free. And if you join, you get those same benefits, right? You get lifetime access, and when I add new segments, you get those as well. So I'm always wanting to reward and give back to people who have given to me. I think that's important, and also you, the viewer, very important. I continue to provide value every single day here. So thank you. If you like this kind of content, make sure to subscribe, like the video, and share it. But look, bottom line, am I really worried about the Fed's 25 BP hike? No, because the economy is just fine right now. The concern is inflation. So mark your calendar because we will know how much longer that fire has to burn based on the calendar. Now, keep in mind, today, we are not going to get a summary of economic projections. The next one will be June 14th, which is the day after the next CPI report. Actually, there are 2 CPI reports coming out. There's a CPI report coming out a week from today. I will be covering that live. Mark these on your calendar, okay? Ready for this? May 5th, 5:30 a.m., jobs. May 5th, 11:59 p.m., course price goes up. May 10th, 5:30 a.m. Pacific, CPI. June 13th, 5:30 a.m. Pacific, CPI. June 14th, 11:30 a.m., Federal Reserve summary of economic projections, and press conference. The summary of economic projections will actually come out 30 minutes before that. Same thing today. You've got the Fed meeting today. We're going to get 25. We'll get some hawkish commentary about like, well, we're going to be data dependent. It's really, the Fed meeting today is going to be, here's 25. We're going to wait for the next 2 CPI reports to see how much longer we have to keep this freaking fire going. At least this number from Nick T here is falling, which is the quits data, which is actually really important to see that people are quitting their jobs less, because when people quit their jobs, it's a sign that they think they could get a better job somewhere else. You don't quit your job if you think you're going to be unemployed, and then you stay. So anyway, look, not nervous. I'm going to continue providing analysis on all of this information, but I really believe in the Nike swoosh recovery. There's no flip-flop. It's just going to be volatile. So we're going to get negative information. We'll get positive information. Look, in the Course Member Live this morning, we went through Ford. We went through AMD. We're looking for signs of a wage price spiral. We're looking for signs of the bottom. We're looking for when one of these numbers are going to get better. For AMD, it's probably Q3, Q4. However, they're getting smashed today. Absolutely smashed today. Now, is it a buying opportunity? Depends what PEG ratio valuation you want to put on them. And if you think they're actually going to get to about 250 in EPS this year and maybe pop that up to about 420 next year. If you get that 250 this year, you're probably at somewhere around a 2 PEG for the company, assuming about a 14% growth rate. So, but anyway, these are things we could talk about more in more detail. But look, for me, I'm doing everything I can to put one foot in front of the other. Make sure we can increase as much revenue as we can, so that way and we're going to do that by providing as much value as we can to the community, and we're going to keep providing value to these courses. And then what we're going to do is we're going to invest in the stocks and companies that we believe in, because we think, yes, the Nike swoosh is going to be very volatile. It may take years to go back to this Nike swoosh recovery for it to actually progress. And that's okay, even if it takes a decade. We want to be in and adding now and increasing our ownership of great companies now during all this uncertainty, because not very fearful. So that's my take. Obviously not personalized financial advice, but again, if you found it helpful, please consider sharing the video. I really appreciate you being here. And hey, folks, we'll see you in the next one.